他妈的，银行都开不下去了。
Banks can't keep running. 36 of them have failed, been dissolved, or merged. That includes their assets, liabilities, operations, and staff. Business is so tough right now. Without cash flow, banks can't survive, let alone private companies. China's economic downturn has begun to ripple through its banking sector, with 199 small and medium-sized banks deregistered, merged, or dissolved by early 2024, far more than the previous 3 years combined. That tally included 36 credit cooperatives, 56 rural commercial banks, and 100 village banks, according to Enterprise Early Warning Tong data. Secretary General Wang Zishen of the China Asia Pacific Elite Exchange Association warns that China's hidden local government debt, tied up in a bursting real estate bubble and unrecoverable loans, poses a ticking time bomb for lenders. He describes a wave of bank consolidations and closures as a form of slow euthanasia that, if left unchecked, could trigger a broader financial crisis.
深圳的银行也快扛不住了。
Banks in Shenzhen are close to breaking too. It's not a lack of funds, it's that they have too much money, right up to a critical point. You might think having more money is good. For individuals, maybe, but for banks, deposits are liabilities. Bank profit comes from the spread between deposit and loan interest rates. Today, banks pay high rates on savings, but struggle to issue new loans, leaving them without a source of profit. At the same time, ordinary people now prefer to save rather than spend or invest, causing banks to incur invisible losses every day. Among China's many banks, the 6 major state-owned banks attract the most attention. Recent reports show that Industrial and Commercial Bank of China, Agricultural Bank of China, China Construction Bank, Postal Savings Bank of China, and Bank of Communications released the first quarter 2025 results. Together, these 6 banks posted revenue of about 910.2 billion yuan, down 13.9 billion yuan year-on-year. 4 of the 6 banks posted revenue declines. Bank of China's revenue rose by 2.6%, while Agricultural Bank of China saw a 0.4% increase. At Postal Savings Bank, revenue growth slipped into negative territory. Bank of Communications revenue decline widened to more than 1% year-on-year. In terms of profit, the 6 banks together reported net profit attributable to shareholders of 344.4 billion yuan in the quarter, earning 7.3 billion yuan less than a year earlier, a drop of about 2%. The group's performance showed 2 increases and 4 decreases. Industrial and Commercial Bank of China recorded a net profit of about 84 billion yuan for the quarter, while China Construction Bank came in at roughly 83 billion yuan. Although both figures stayed above the 80 billion mark, each bank still posted an annual decline of close to 4%, after seeing drops of less than 3% in the first quarter of 2024. Bank of China saw its net profit attributable to shareholders fall by 2.9% year-on-year, roughly in line with the prior period. At Postal Savings Bank of China, the comparable profit drop widened to 2.6%. Agricultural Bank of China and Bank of Communications both posted gains. Agricultural Bank led the group with a 2.2% rise in net profit after a 1.6% decline in the first quarter of last year and a full-year increase of 4.7%. Non-performing loan balances at the 6 major state banks continued to climb in the first quarter of 2025. Industrial and Commercial Bank of China recorded the largest increase in bad loans, with its non-performing loan balance rising by 15.9 billion yuan over year-end levels. China Construction Bank's bad loans grew by 13.5 billion yuan, Agricultural Bank's by 12.5 billion yuan, and Bank of China's by 12.4 billion yuan in the same period. Postal Savings Bank of China was the only one of the big 6 whose non-performing loan ratio edged higher. At the end of March, its ratio stood at 0.91%, up 0.01 percentage points from year-end. At the end of March, non-performing loan balances were 395 billion yuan at ICBC, 358 billion yuan at China Construction Bank, 335 billion yuan at Agricultural Bank, 281 billion yuan at Bank of China, 85 billion yuan at Postal Savings Bank, and 115.5 billion yuan at Bank of Communications. Together, the 6 banks held approximately 1,570 billion yuan in bad loans. As early as the first quarter of 2024, 4 of the Big Six, ICBC, Agricultural Bank, China Construction Bank, and Bank of China, already recorded declines in both operating revenues and net profit. ICBC posted revenues of 219.8 billion yuan, down 3.4% year-on-year, the steepest fall among the state banks. China Construction Bank and Bank of China's revenue also dropped by 3%. Beyond the 6 state-owned giants, A-share listed banks face severe pressure on their net interest margins. Over the past year, all 42 listed banks saw their margins narrow, with declines ranging from 1 to 51 basis points. Beijing Business Today reported that Ping An Bank, China Zeshang Bank, Bank of Suzhou, Guiyang Bank, Zhenzhou Bank, Jiangyin Rural Commercial Bank, and Zhangjiagang Rural Commercial Bank each saw net interest margin drops of 30 basis points or more. Meanwhile, China Everbright Bank, Huaxia Bank, Changsha Bank, Qilu Bank, and Rufeng Rural Commercial Bank logged year-on-year margin declines of around 20 basis points in 2024. Data from the National Financial Regulatory Administration show that commercial banks' net interest margin stood at 1.5% at the end of the fourth quarter of 2024, down 17 basis points year-on-year and at a historic low. Economist David Huang told overseas media that China's banking system is not market-driven. Loan and deposit rates are set directly by the central authorities, and banks essentially earn guaranteed profits from the official interest rate spread. This has produced a highly bureaucratic system. The declines in both revenue and profit indicate that banks are not generating gains through investment or business operations. Instead, they rely on policy-driven rate barriers to secure near-certain returns. Their main source of their profit remains loans to small and medium-sized enterprises. Thin profit margins also reflect past overexpansion, wasteful spending, and bureaucratic practices that have driven up administrative costs, further eroding profitability. The second factor is weak private sector activity. Fees from transfers, trading, and other transactions once bolstered bank income, but with economic activity subdued, these fee-based revenues have fallen. With few opportunities to earn elsewhere, individuals and businesses are avoiding new loans. Meanwhile, banks must still accept deposits and pay interest, squeezing their margins further. The third factor is that banks once profited from selling wealth management and insurance products, but over the past 3 to 4 years, frequent product failures have shaken public confidence. Consumers now buy fewer of these products, and with less money to invest, that profit stream has largely disappeared. Fourth, the downturn in the property market has cut deep into the bank earnings. Mortgage lending once contributed a significant share of profits at the 4 biggest banks. Under past policy support and non-market rate protections, banks thrived on growing loan volumes. Now, with real estate activity stalled, that source of profit has dropped sharply. The fifth and final factor is that rising bad loan ratios are eroding bank returns. Defaults on credit cards, mortgages, and corporate loans push up non-performing loans and deal a direct blow to the bank's profits. Economist David Huang warns that China's bank profit margins will shrink rapidly in the future and may even turn negative. Data from China's National Credit Asset Registration and Transfer Center show that by the end of the fourth quarter of 2024, banks had 123.5 billion yuan in non-performing loans listed for transfer, up 56.7% year-on-year. In that quarter, joint stock banks remained the main sellers of bad loans, with 34.8 billion yuan of transfers. Official CCP data put banks' bad debts at 3.3 trillion yuan, plus another 4.8 trillion yuan in special mention loans, including credit to struggling property developers and cash-strapped local governments. Opaque reporting suggests the true figures may be even worse. China's bad assets fall into 3 categories. Reuters reports that the first category is debt from local government financing vehicles, bonds issued by local authorities. According to IMF data, China's local government debt exceeds 60 trillion yuan in 2023. Fitch Ratings estimates that loans to local governments account for about 17% of banks' total assets. Because of the political nature of these debts, banks have no choice but to roll them over before maturity, a practice that erodes profitability. Asset manager PIMCO says 15% of these bonds require renegotiation, cutting banking sector profits by 6%. As for the other two types of bad assets, Chinese banks typically try to remove them from their books or absorb the losses through provisions. The second category of bad assets include those that can be sold, auctioned, or securitized. Because China's bankruptcy procedures are underdeveloped and encumbered by complex restrictions and lengthy court settlements, banks prefer to transfer toxic loans directly to state-backed investment vehicles, known as asset management companies, rather than realize losses on their investments. For example, Bank of Bohai planned in 2024 to sell 29 billion yuan of assets at 40% discount, wiping out more than 3/4 of that year's earnings. Asset management companies themselves often lack liquidity, acting more as clearinghouses than investors. The third category covers loans that banks attempt to recover themselves, using provisions to absorb any losses on unpaid balances. In 2024, non-performing loans at the 6 major state banks rose across the board. At Bank of Communications, the bad loan ratio fell to 1.3%, but the non-performing loan balance rose to 111.7 billion yuan, up 5.7% year-on-year. This increase was especially pronounced in retail and property portfolios. Yet these figures underestimate the true severity of the crisis. Economist Li Hongqing says banks' bad debts are tightly linked to the collapse of the property sector. Real estate once accounted for 30% of China's economic growth, and more than 4,000 banks entered the property business during its boom. At the time, the Chinese Communist Party promoted a grand myth that real estate was a sun-never-sets industry. Today, that claim has fallen apart. The market has collapsed, and nearly all property loans have turned into bad debts that banks cannot recover. Borrowers are simply walking away and abandoning their loans as repayment no longer made sense. And with Chinese housing prices still set to fall, the resulting losses are enormous and will ultimately crush a large number of commercial banks. Unless the government delivers strong support by printing money, there is no alternative way to revive these banks. Economist Li Hongqing warns that the situation is dire. At this rate, China's banks are on the brink of a massive debt crisis. Researcher Lynette Ong at the U.S. think tank Asia Policy Institute said the weakest link in China's financial system lies in the 3,800 small and medium-sized regional banks scattered across rural areas. They can only attract local deposits, and regulations bar them from opening branches or serving customers outside their home provinces. As a result, they rely heavily on government-related projects, especially developers and real estate ventures, leaving them fully exposed to the real estate collapse. For the past 2 decades, the CCP has driven growth through investment-led credit allocation to state and private enterprises. Reuters reports that this growth model can no longer continue and the risks keep rising. If consumer spending does not fill the gap, the economy will slow and bad loans will increase, turning financial ingestion into a worse crisis. Against this backdrop, China's Ministry of Finance injected up to 500 billion yuan into its 4 largest state-owned banks: Postal Savings Bank, Bank of China, Bank of Communications, and China Construction Bank. Bank of China received the largest share at nearly 165 billion yuan, while each of the other 3 took in over 100 billion yuan. Central enterprises, including China Tobacco, China Mobile, China Shipbuilding, also subscribed, adding about 20 billion yuan in total. Banks normally bolster their core Tier 1 capital through internal means such as retaining earnings, as well as external measures like share rights issues, private placement, convertible bond offerings, and attracting strategic investors. It is rare for them to use special sovereign bonds for capital injections. Commentator Xiao Yi says the financial ministry's cash infusion may delay the outbreak of bad loans at the 4 banks, but it cannot solve deeper problems: weak profitability, hidden bad debts, oversized credit expansion, and the systemic risks posed by the U.S.-China tariff war. It's important to note that the U.S.-China tariff war will impose large additional credit losses on China's banking sector. Tariffs have sharply escalated, with the U.S. now charging an average rate of 245% on Chinese goods. High duties weaken Chinese products' competitiveness in the U.S. market. Export-reliant industries, electronics, machinery, and apparel are hit first. They face order cuts, revenue declines, and tighter cash flow, making debt repayment harder. Overdue and non-performing loans rise, and banks see higher lending risks in these sectors. The tariff war has slowed exports and hurt firms across the supply chain, especially in coastal provinces such as Guangdong and Zhejiang, where export businesses depend heavily on bank credit. If the default rate on export-linked loans rises by 1 percentage point, then based on 2024 corporate loan balances of 98.3 trillion yuan, credit losses could climb by nearly 100 billion yuan. The 6 major state banks could bear more than 60% of that, or about 60 billion yuan. S&P Global said in an April 3rd report that the U.S.-China tariff war could cause Chinese commercial banks to incur average annual credit losses of up to 2.7 trillion yuan. The report added that small firms with less financial flexibility may struggle to absorb extra tariff costs or pass them on to customers. It estimated that the non-performing loan ratio for small and medium-sized enterprise lending will rise to 9.3 to 9.6% in 2025 to 2027. According to Carnegie Endowment for International Peace report, by the end of 2024, China's non-financial sector debt had climbed to 303% of GDP, well above the global average of about 238%. This marks high debt levels for businesses, households, and government, and heavy pressure to repay. High debt raises default risk, especially during a weak property market and an economic downturn. This could trigger systemic financial risk. China's banking sector is on the brink of crisis. State-owned banks, commercial lenders, and smaller institutions alike are under extreme stress. Widespread bank failures would push up systemic financial risks and threaten to bring down the entire financial system in a domino effect. With the economy slowing, the collapse of banks would herald a much larger financial breakdown.